we want to discuss IAS 21, which is the standard on the effects of changes in exchange rates. The effects of changes in exchange rates. Okay, so this particular standard is normally it's usually examined in our SBR paper. And the concepts we are going to discuss today are so important. But before I move on to that, last week I sent you a video link for you to play, and make sure I'm of the opinion that everyone has played that particular video, which was about illustrations on groups. Did you guys manage to play the video?
Yes, I did.
Okay, perfect. So for those who shall play this video, was our classmates who haven't played the video or watched the video in its entirety, you need to do so. Otherwise, you will not be doing yourself any favor. So let me show you the screen. Allow me to show you my screen so that we proceed in equal. Oh, I've just opened this now. All right. So I understand you have this open with you because I'm sure it was sent to you. Let me check in time before this particular lecture. Yes, the pre-read material. So in other words, we are not necessarily going to read anything, to write anything. Suffice when we are answering illustrative questions there. As you can see at the end of our reading, our notes, we do have past exam questions. So we shall end our discussion with this paper. It's March-June 2019 question paper, and also we have another illustrated question, Henley group. So quite a lot. Please, so for today's lecture, be prepared at least that we finish at 9, because we want to wrap up all the two illustrative questions here. Okay. All right. So first things first, I have done the everything. The issue of writing the notes, I have typed everything for you. So it's a matter of just paying attention. You know, IAS 21, as I said, effects of changes in exchange rates. This particular standard sets some definitions on what is foreign currency. You know, foreign currency is a currency which is not the functional currency of an entity. So an entity has got what is called the functional currency, like the primary currency in which the entity operates, the currency of the primary economic environment in which the entity operates. That is called primary functional currency. So if you take South Africa, for example, the functional currency is the rand. It is the primary, meaning it's a currency in which the most competitive forces are priced, like the currency in which we price ourselves, we price our labor, our raw materials and stuff. That's the currency. We shall discuss shortly on how functional currency is determined. So in Zimbabwe, of course, the functional currency is the Zimbabwe dollar, though we have other currencies, but that does not make them functional, because they are not primary. They are not the currency of the primary economic environment in which the entity operates. Now, we do have what is called presentation currency. In other words, currency in which financial statements are presented. Now, according to IAS 21, an entity can present financial statements in any currency. You know, there is no, even if you are in Zimbabwe, you can prepare your financial statements in euros. Even if you are in SA, you can prepare financial statements in US dollars. But so the board has prerogative of choosing the presentation currency not the functional currency, but the presentation currency, meaning currency in which it prepares financial statements. However, it must be a currency in which we get our equity financing, because remember, financial statements, they need to appeal to investors, which are currently the present investors are shareholders. So make sure that the currency, normally the currency in which shareholders gave the money, invested the money, is the presentation currency. Exchange rate, as you know, is the ratio of exchange of two currencies. In other words, the price of a currency in terms of another, like one euro equals $1.13. That's an exchange rate. Exchange difference, exchange difference, they are like exchange losses or exchange gains. These are the difference which arise from translating a given number of units of one currency into another at different exchange rates. Whenever exchange rate is moved, there is either an exchange gain or an exchange loss. And that one, because we don't know for now whether it's a gain or loss, we just call it exchange difference unless you are given a transaction which tells you whether this is a gain or loss. So exchange differences arises whenever exchange rate have moved and the monetary amount or units of one currency that you are translating have not changed, but the exchange rate has moved. Closing rate, closing rate is the exchange rate or spot exchange rate at the year end. That's the closing rate. Make sure you shall take note of these definitions. Monetary items, concerning business in foreign currency, there are two types of items. There is what is called monetary item, and there is what is called non-monetary item. There are monetary items and there is non-monetary item. Monetary item, they actually involve movement of cash, be it from foreign currency, from a forein operation to the home parent, to the parent, or you are just paying for a foreign currency transaction, or you are expecting to receive foreign currency. Like if you have got receivables in one country, it's a monetary item, because if you are expecting to receive receivables in another currency, it's a monetary item, because it will actually result in cash transaction. You get that? Or if you are expecting to receive cash in another country, like you have got a foreign subsidiary which is in Botswana, which reports in Pula. So if it has got bank balances or cash in Pula, it's a monetary item because it's the actual money. If you're expecting to make payments, foreign loans and stuff, these are actually monetary items because there is a given amount of monetary units that of that particular currency that you are going to pay or receive. So we call them monetary items. So there is monetary and non-monetary item. Now I have to tell you what a non-monetary item is. Let's say you now have a building which is in Botswana, in Pula. The building is in Pula. That one is a non-monetary item because there is no actual cash movement each year, or you are not expecting actual cash movement. It's different from receivables or payables which are in Pula. Unlike having a building in Botswana, a land in Pula, that one is non-monetary item because there is no actual cash movement that you're expecting with regards to that. But it's so I'm sure the difference is clear there. Even if you have got inventory, suppose there is inventory in Botswana, it's a non-monetary item there. It's a non-monetary item. Right? Then, concerning exchange rates, there are two words which we use. There is what is called, concerning exchanging of currencies, there is what is called conversion and translation. Conversion arises when you are exchanging amounts of one currency for another. Like you have got 100 Pula, you want to convert it to rands, or you get 200 rand, you want to convert it to dollars. We call it conversion. there is actual exchange of currencies. And then there is translation. Translation, there is no exchange of currencies. By translation, what you are simply doing is you are restating the financial statements which are in another currency. You are restating them to another currency. Suppose financial statements are in Pula, and you are preparing financial statements in Zim dollar. So you have to translate the Pula financial statements to dollar financial statements. So translation doesn't involve cash movement. It is required at the end of an accounting period when a company still holds assets or liabilities in a statement of financial position which were obtained or incurred in foreign currency. We have to translate. Those assets and liabilities to the presentation currency. So translation it's merely about a restatement of financial statements in one currency from one currency to another. Now there is what is called foreign currency transaction. There are two things. There is what is called foreign operation, meaning a company which is outside the country, or a division or a branch or a subsidiary that you have which operates outside the country. That is called a foreign operation. But if you are in Zimbabwe and you buy a combine harvester from Japan, for example, you buy a combine harvester from Japan and payment is to be made, let's say, over 6 months. When you have such a transaction, that one is just a foreign currency transaction. Because in Zimbabwe, you have your presentation or your functional currency as the Zim dollar. If you buy a combined harvester in foreign currency, you have to convert that particular cost from Japanese yen to dollars. So this is key number one. At the date of transaction, whenever you incur a foreign currency transaction, whether you make sales in foreign currency, you get purchases in foreign currency, on the date, it's important to make sure you record in your functional currency using the exchange rate prevailing at the date of transaction. But however, for things like sales and purchases and stuff, you may use what is called average rate, because these there are a lot of transactions of these, so you can average using the average rate for the period, provided these things did not fluctuate significantly. So that's it for a monetary transaction. Non-monetary transaction, once you make a transaction in foreign currency, you need to present it in the functional currency. You can't open your ledger in Zimbabwe and begin to put assets under Japanese yen. No, you have to use exchange rate which is prevailing at the date of transaction. Now you notice what I've just said. I said in this particular case, let us assume that this particular asset you have bought from Japan. Suppose you buy that asset on 1 October. Payment is to be made monthly over 6 months, and your year end is 31 December. So in other words, it means come 31 December, you will still have a payable. You still have payable because you need to make these payments in the next 3 months. You said October, November, December, you made the other 3 payments, and then you are left with January, February, March. So when you still have to make payments at 31 December, we say it's a monetary item because these are payables. Already you have your asset which you've acquired, but you still have payables. Remember, so these payables need to be paid. So if suppose at 31 December there is 30,000 Japanese yen to be paid, you need to disclose the liability, the 30,000 Japanese yen. You have to disclose it to include it among your payables in Zimbabwe dollars. So you use the exchange rate which is prevailing at 31 December. Because if I am a director and I tell you, I ask you, How much do we still owe that Japanese supplier at year end? You can't say, you can't use the exchange rate which was prevailing when we acquired it in October. No, because the exchange rate has moved. And remember, a statement of financial position is prepared as at. So when I say how much do we still owe that particular Japanese supplier, you have to tell me the exchange rate which is prevailing as at 31 December, just in case you want to pay on that date. So if this is likely to be different from what it was, if the exchange rate, what it was supposed to be, if the exchange rate had not changed. If the exchange rate has not changed, the amount in Zim dollar terms is likely to be different with the one we get when we use the exchange rate at 31 December. And the difference is called exchange gain or loss. So the exchange gain or loss, it's calculated like, if the exchange rate has not moved, your liability was supposed to be at what? And now the exchange rate has moved to this. In Zim dollar terms, what is now your liability? So if the liability has increased, it's an exchange gain. I mean, it's an exchange loss. But if the liability has decreased, it's an exchange gain. Suppose these were trade receivables. If they increased because you have used an exchange rate, a different exchange rate, it's an exchange gain. If the trade receivables have decreased, it's an exchange loss. You get that? So that's what I'm saying here when I'm saying subsequent measurements, meaning at each and every reporting date, what you need to do is, if it's a monetary item, meaning you are expecting to pay or receive, you have to translate that monetary item using closing rate, the rate which is prevailing on the date we are preparing financial statements. Now, for non-monetary items like property, plant, and equipment, let's say the asset that we have purchased, for non-monetary items like the combined harvester which we have purchased, it depends with our model, the model we are using to recognize this. If we use cost model, there is nothing we can do because the exchange rate which was prevailing at the date of purchase was its cost. If you convert it with the exchange rate prevailing at the date of purchase, we get the cost of the combined harvest. So you still depreciate it at that cost. There's nothing you can do there. You are now depreciating in Zim dollars. You converted it at cost, meaning exchange rate prevailing on the date of transaction. You converted it, you got the cost in Zim dollars, so you are now depreciating it in Zim dollars. Same with inventory. If it is measured at cost, you follow that analog. But if it was like, say, investment property, which is measured at fair value, for example, you know, there are properties which are measured at fair value, like investment property. According to IS 40, if you have got a piece of land or a building that you rent out to third parties, or you just keep for capital appreciation, we call it investment property. And the standard requires investment properties normally it requires entities to use fair value model, meaning at each reporting date we have to find fair value. So if your investment property is in Botswana, where the fair value at each reporting date is in Pula, you need then to use exchange rate which is prevailing whenever we get the fair value. You get that? Suppose the fair value was obtained on 22 December. You report your investment property in your statement of financial position using the exchange rate which was prevailing when we determined the fair value. If that property is revalued and the revaluation is done in Pula, you use the exchange rate which was prevailing when you revalued that property. But of course, if it is still in existence at the year end, you still need to convert, because once you revalue, it means you then begin to depreciate on the revalued amount. So once you convert it using the exchange rate which was prevailing at the date revaluation was done, that becomes your new carrying amount, and you then have to depreciate it. like that. So this is what we have here, that for non-monetary items such as non-current assets on inventory, which are carried at historical cost, in the foreign currency using you just use exchange rate which was prevailing at the date of transaction, because they are carried at cost. Once we used the exchange rate on the date of transaction, we got the cost. But for non-monetary items which are carried at fair value, you may remember to convert them from foreign currency to your presentation currency using the exchange rate, or to your functional currency using the exchange rate which was prevailing when the values were measured. Please, theory is important in your exam. Make sure you understand this and you nip it you actually get it right. Recognition of foreign exchange differences. I have already said about this. I have said, like on point number B, which says, if the transaction is settled in this subsequent accounting period, in other words, at 31 December, we still have to receive or pay foreign currency. I said we retranslate it using the exchange rate, the closing exchange rate. And if there is a difference, we recognize that in profit or loss. So we are told that the exchange difference recognized in each intervening period up to the settlement is determined by the change in exchange rates during that period. In other words, if it's a monetary item which has not been settled or which has not been received or paid at the year end, it should be restated using the closing rate, and any gain or loss, meaning exchange gain or loss, we then take it to profit or loss. So let us have an example. So already you have got the notes. Make sure you are creating a folder where you keep this information that I give you as handouts, so that you don't lose track of what we are doing here. So like an example, I'm just trying to show you how we account for a foreign currency transaction. Atlan's company, whose year end is 31 December, buys some goods from Rinka SA of France on 30 September. The invoice value is 40,000 euros and is due for settlement in equal installments on 30 November and 31 January. The exchange rate has moved. So notice the year end is 31 December. And payment is to be made in equal installments on 30 November and 31 January. So we will get to 31 December still with an amount to be paid. The exchange rate has moved as follows: euros per dollar. Notice the exchange rate notation. If the exchange rate says euros per dollar, it means these are euros, which give you $1, not that these are dollars. I need people who are good at reading exchange rate, guys. If they say euros per dollar, they are telling you that these are euros. They are not dollars. They are euros, which give you $1. Now, state the accounting entries in the books of Atlantic Resources. Let me open now in Excel to show you how the accounting entries will look like. Allow it to open. Right? All right. Okay, so here you go. So let me read the question again. Atlan's company, whose year end is 31 December, buys some goods from Rinka SA of France on 30 September. The invoice value is 40,000 and is due for settlement in equal installments on 30 November and 31 January. The exchange rate moved as follows. So these are the exchange rates which were prevailing in the relevant periods. So you have got Atlas Company, right? So if they say show the accounting entries, the proper way of showing accounting entries is journal entries. Journal entries. Journal entries. Right? And journal entries are known by debit, credit. You know that. So it's important if we may have debt, then description and our debit, credit. All right. So I put here date. Please pay attention to what we are doing here. Description or detail. Let's say detail. Here, let's say debit. Here, let's say credit. You know, Atlas resources, our functional currency is in dollar, because we are talking of these Atlas resources. So we know we are in ZIM. So in that question, we are not given the functional currency on the assumption that because I'm the one teaching you, you know that we are in dollars. So you record everything in ZIM dollar like that. That's our functional currency. So we purchased the goods on 30 September from Rinka SA of France. So we have got 30 September. We are told that we purchased some goods worth 40,000. 40,000, and the exchange rate was, the goods were worth 40,000 euros, and the exchange rate here was 1.6 euros equals $1. So because you need to know, actually with the exchange rate, you need to know, am I supposed to divide or to multiply? Let me know. If you are converting from, if the exchange rates are given like that and you are converting from euros to dollars, are you supposed to divide or multiply?
You divide.
You divide. Good. So let me put $sign. If I say ZWL, it may confuse some of you. Let me put $sign. So you bought some goods, so you debit purchases. Don't get, these are basic accounting entries, guys. Debit purchases, credit payables. Now, how much do you debit? You say 40,000 divided by 1.6, meaning exchange rate on the date of transaction. So you say equals 40, 1, 2, 3 over 1.6. So 25, and you credit there with 25,000. So the narration is simple. Purchases made, it's like purchases made in foreign currency. Purchases in foreign currency. Foreign currency. Now, so if I can underline this part here. Now, they are saying payments is to be made in equal installments on 30 November and 31 January. So the next date here is 30 November. 30 November. Now, 30 November, we are going to make a payment. They are saying in equal installment, meaning it's 40,000, it's 20,000 and 20,000 because it's equal installments. So on the day you make a payment, here's how you go about it. In ZIM dollar terms, we know that we are paying half. That because if they say 2 equal installments, it means half. So in ZIM dollar terms, what we know is we are paying half. Pay attention to this. So we say payables. payables like this, what we know is we are paying half, meaning we are paying 12,500. That's what we know, because it's equal installments. But the amount that you then have to pay must get to France as 20,000 euros. So you skip a line and say bank. Now, if you go to the bank, they will give you the exchange rate ruling on the date of transaction, meaning on the date you make a payment. They say, look, you want to pay 20,000 euros. Here is the exchange rate, 1,8. So you simply, so in the bank, they say 20,000 divided by 1,8. So that's the amount which will be credited from the bank. 20,000 divided by 1,8. So notice what has happened. What has happened here, it's something interesting. What has happened is a situation where the amount you have debited in your ledger is different from what you have in the bank. So if you are to tell your neighbor, you say, a payment which was supposed to be 12,500, if the exchange rate has not moved, it was supposed to be 12,500 if the exchange rate had not moved. But you are now paying it as 11,111. So is this a gain or a loss to you? Talk to me.
It's a gain.
It's a gain, good. So the gain, you then say profit or loss, statement of profit or loss, exchange gain. Exchange gain, it's a balancing figure. Exchange gain, it's a balancing figure, so it becomes equals 12 minus 11. So that's a gain, 1388.89. So narration may be payment of first installment. That's how we'll be doing it, of first installment. So this will be shown as other income. Are you noticing something also containing exchange gain? Notice something. It's a non-cash item. So when you are doing statements of cash flows, remember that fact that exchange gains, they don't involve cash movement. It's just a paper adjustment. Now, because another thing is your year end is 31 December, and I said when it's 31 December or it's your year end, you need to restate. You get that? You restate the liability at closing rate because you still have it. So if directors, if your managers say, look, can you tell us how much do we owe that French supplier? You tell them we owe that French supplier 20,000 euros. But remember, directors, they need to know the amount in dollars because the currency is in dollars. So what then do you do? If you then have to retranslate or to translate the 20,000 euros using the exchange rate at 31 December. So from your ledger, notice, from your ledger, the figures in yellow are telling you that so far you owe the supplier 12.5, right? Because you credited 25,000 and you debited 12.5. So your ledger is telling you that you owe the supplier 12.5. But this 12.5 is determined using the exchange rate which was prevailing on the date of transaction. And I said we need to get the value using the exchange rate prevailing at reporting date. So at reporting date, you say equals, we owe 20,000 euros divided by 31 December exchange rate, which is 1,9, divided by 1,9. So you would notice that from your books, if you are to print it now, today, suppose you are to print it now, you would notice your books will say you owe the supplier 12.5. But because the exchange rate has moved, the 20,000 which is outstanding is no longer 12.5. It's now 10,526. So Well, is there an exchange gain or loss in your opinion? Because the liability is no longer 12.5 but 10,526. It's an exchange what?
Exchange gain.
It's an exchange gain again, correct. So what you then do is, if directors say, how much do we owe that supplier again? You need to bring down your liability from 12 to 10.5 by recognizing an exchange gain. So you say, it's not a payment, it's merely a matter of restating your liability using closing rate. So you say, payables, you have to reduce payables, but they are being reduced without payment. So it's 12.5 minus 10,526. So it's 1973, and then you say statement of profit or loss, exchange gain. This one is not a balancing figure. Gain is the same amount. Now, what is the narration to this? It's called restating the liability at closing rate. Restating the liability at closing. The liability at closing rate, and how have we calculated it? We said, remember in our books was 12,000, it was 12,500. But we know that in foreign currency, this is 20,000 divided by 1,9. So it has decreased. So that decrease is an exchange gain. Let me repeat. You notice you first find how much was it supposed to be if the exchange rate has not moved. It was supposed to be 12.5. But now the 20,000 euros you owe, if you exchange that, if you translate that with closing rate, it is supposed to be how much? 10,526. So the liability has decreased without being paid. And what has contributed to that decrease is an exchange rate movement. You get it? So in your books from now on, you now have 10,526. So on 31 December, January, when you make the final installment like this, 31 January, you know this is a final installment. So what you do is you say payables. Your payables should now have zero balance. So your payables is 10,526. You understand that? Because that was the carrying amount. This is the carrying amount of your payables. But this being the final installment, you need to pay 20,000, and you need to know the rate which the bank is using. So you say bank, the amount you are paying is 20,000. The bank doesn't say how much do you have in your books. They say how much are you expecting to pay. You say 20,000, and then they tell you the exchange rate for that day, 1,85. So divide by 1,85. And then what you get, the amount which gets credited to from the bank is 20,000 divided by 1,85, and you get 10,810 like this. So if you are telling your neighbor, you say, my liability was 10,526, but because of the exchange rate, I'm now paying it as 10,810. Is that an exchange gain or an exchange loss? Talk to me. Talk to me, guys.
It's a loss.
It's a loss because you are now paying more. So you say statement of profit or loss. Then you say exchange loss. Exchange loss. It's a balancing figure. Exchange loss. It's a balancing figure. You need to have your journal. So you can see that if it's a loss, it's a debit to profit or loss. If it's a gain, it's a credit to profit or loss. And the narration is payment of final installment. Payment of final installment. That's the narration there. So I'm sure you need to, this part, you have to replay it because I need you to be super confident with your determination of exchange gains or losses. And believe you me, this is what some of your colleagues are doing almost yes, more blessing. I can see a raised hand. Talk to me.
So I wanted to ask about narrations. Is it a must that we should put them, or we can decide not to put them?
Yeah, you can actually decide not to put them, but because these are not, it wouldn't make sense if I leave them out.
Okay.
Yes, it would make sense. Because I want the points to be clearly explained. No wonder why I'm putting them. In your exam, you can just you can just did you manage to play last week's video, which I sent? Of course.
Yes.
Yeah, you realized the way I was putting journal entries, yeah, and you notice we were not necessarily putting narrations, right?
Yes.
Yes. So it's equally important. So that's it. I'm sure you're answered. So this is how you account for a foreign currency transaction, meaning you bought something in foreign currency and there's still a monetary item, meaning there's still a receivable amount you want to receive or a payable amount you want to pay at reporting date. Make sure you retranslate it at reporting at the closing rate. This journal is so important, the 31 December journal, where you have to retranslate at closing rate to sort out your issues. Okay, now continuing with my explanations of the handout. Now, consolidated financial statements stage. What I mean by this, please pay attention. I am saying you now have a foreign operation, not like you now have a transaction. This is now a foreign operation, meaning it's either a subsidiary, a branch, a division, which is in another currency or in another country, so to speak, a foreign operation. You do notice under normal circumstances, what you need to do is before that particular operation might be preparing financial statements if it's in Botswana, it might be preparing in Pula. So you then have to translate the Pula financial statements to your functional currency before you can consolidate. But you need to understand what a foreign operation is. As I am saying, it's either a subsidiary, an associate, a joint venture, or a branch. It's like that, which is conducted in another country, or which is preparing financial statements in a different currency. Right. So you can have what is called a net investment in foreign operation. In other words, you get the net assets of that particular foreign operation, like what we do with an associate. If there's an increase or if there was a profit made by the associate or increase in reserves or net assets of the associate, you get your share from that. We call it a net investment in a foreign operation. But what I want you to know is, and I want you to know this, two things. When you have got a foreign operation, the first task is to determine its functional currency. It's not given that if an operation is in Botswana, it's automatic that it's preparing financial statements in Botswana. It's not. Do you know we have got companies here in Africa which prepare financial statements not with the currency? For example, Total. If you know Total, that oil giant, they prepare financial statements every day. They submit their returns in euros. But a company is in Zimbabwe, a company is in South Africa. It doesn't prepare financial statements in South African rand. It prepares them in euros. So it's one thing to say a company is in Botswana. It's another to say it is preparing accounts in Botswana. No. In Pula. No. So if you then figure out that the functional currency of that entity, in other words, the currency of the primary economic environment in which that particular entity operates is different from Zim dollars, you then have to translate the financial statements of that entity to the presentation currency of the parent, because we are preparing financial statements here. So those are presented in another currency. They have to be translated to get to the presentation currency of the parent, or the functional currency of the parent, which is normally the same currency. You get that? So the key task you need to undertake is first to determine the functional currency of your foreign entity. There is a lot of things we look at. Pay attention to this one. For you guys who are in Zimbabwe, you know that in Zimbabwe we use a lot of currencies. We use rand, we use this US dollar, we use the Zim dollar, we use the Pula, we use all these currencies. Now, if you are asked the question, which one of these currencies is a functional currency? Clearly, you can't say all of the above. No. You can't say all of the above are functional currencies. No. In Zimbabwe, this is not an issue. You would say, in as much as we use the US dollar a lot, but it appears significant chunk of transactions is being done in Zim dollars. You know, or you can say, well, you can use judgment and say, well, as far as this particular entity is concerned, even though in Zimbabwe, most of the entities use US dollars, use Zim dollar, but our operation in Zimbabwe is getting its sales in the US, paying its labor in US dollars, acquiring raw materials in US dollars, obtaining finance in US dollars, retaining cash flows from operations in US dollars. So clearly, the functional currency of this particular operation is the US dollar. So it's not like every country, every entity in Zimbabwe should report financial statements in Zim dollars. It depends on what, after analysis, thorough analysis, for our financial statements to meet the needs of its users. Which currency do they really are they presented in? So here are the issues which you need to consider when we are determining the functional currency of a foreign operation. You know what? Before I come to the factors that you need to consider, let me explain this part because I'm sure it's important. I want to give an example to explain it. Let's say I have my branch in Botswana, which is in Francistown, just near to our Zimbabwe border here. Suppose I've got a branch, a supermarket there, I'm Pick and Pay, and I've got a Pick and Pay Botswana branch. Now, notice, if I give instructions to those managers to say, all your sales, even though they are in Pula, make sure they are being banked in US dollars every week. I am giving them instructions. They are selling in Pula, fine, because they're in Botswana, but I'm telling them that all your sales, make sure is being banked in Pula every week. Then that's another thing. Or I can say all your cash flows from operations, if after we have calculated them, we have to retain them in dollars. So in other words, notice, or even if I say, if you need debt financing, you get it in dollars, even though they are in Botswana. Are you noticing now that the substance of this agreement is of such nature that their currency is the dollar? Because they are, even though they are selling in Pula, but it appears they don't have autonomy to retain currencies in Pula. They can't decide that. So, if their currency then is the dollar, due to the substance of this agreement, it would mean that their currency is the same as my currency. So we don't translate the financial statements because their currency is the same as my currency. So we call it an extension of the parent. It's an extension of the parent. If the foreign operation management, they don't have autonomy to choose which currency to keep their cash balances, to retain their cash flows from operations, this currency is still being decided by the parent, and is the currency of the parent. Under the circumstances, we don't say they should prepare financial statements in pula. No, they should just prepare financial statements in dollars because it's an extension of the parent. So if it is an extension of the parent, there is no need to consolidate. I mean, there's no need to translate because the financial statements will be the same. So all you have to do is to consolidate because the currency is the same. But if you then, same example, Botswana operation. Now they sell in pula, they bank in pula, they pay wages in pula, they raise cash flow, they retain cash flows from operations in pula. And if they need debt financing or equity financing, they can issue bonds. They can issue bonds in pula. Now, under normal circumstances, their functional currency becomes the pula. It becomes the pula. So they have to prepare financial statements in pula, and we need to translate those financial statements before we consolidate. So if it's an extension of the parent, it's the same currency both ways. So it's a matter of just consolidating right away. But if it's now different functional currency with the parent, we call it a net investment in foreign operation. That now becomes a net investment, meaning as a parent, you are now concerned with your share of profits, your share of increase in reserves or in net assets. That's a net investment in foreign operations. So you have to consolidate, to translate and then consolidate. So you have it here. So I'm reading. A holding or a parent company with a foreign operations must translate financial statements of those operations into its own currency before they can be consolidated. You get that? There are two methods. The method depends on whether the foreign operation has the same functional currency as that of the parent. If it has the same functional currency, you treat it as an extension of the parent. Meaning they are reporting financial statements in the same currency. So it's a matter of consolidating right away. But if it's a net investment, it means they've got different functional currencies. So you have to translate subsidiaries assets first. Now, these are the factors set out in IAS 21 for the determination of functional currency. They are quite a lot. So the standard is very liberal in telling us what do we have to consider when we want to come up with functional currency of a foreign operation. You consider the currency that mainly influences sales prices for goods and services. That's A. B, the currency of the country whose competitive forces and regulations mainly determine these prices. When they are saying competitive forces and regulations, in other words, the currency which you mainly pay tax, the currency in which your competitors in the industry, like buyers, suppliers, competitors, which currency do they really favor? Which currency really determine the selling prices? So that's the functional currency. Another is the currency which influences labor, the currency which you pay your materials and other costs. So it's a lot. If this information is not enough for you to get the functional currency, you can as well use some secondary and some secondary information, like the currency in which cash flows from financing, that is loans and equity, are generated. The currency in which receipts from operating activities are usually retained. In other words, the cash flows from operations is usually retained. Right? If again this is not enough, you need to consider this. You need to consider whether the activities of the foreign operation are carried out as an extension of the parent or rather than or rather than being carried out with significant degree of autonomy. Like when I said Botswana operation, I asked them to do a lot of things so that they don't have any autonomy. So if they don't have any autonomy, they are merely an extension of the parent. Whether the transactions with the parent are high or low proportion of the foreign operations work, you look at that. Whether cash flows from operating activities of the operation directly affect the cash flows of the parent. Meaning, are they remitted? Suppose I said, make sure you bank in dollar account every week. In other words, cash flows of the parent are being affected on a weekly basis, because here they are banking the cash flows in our dollar account every week. So in other words, there will be an extension of the parent under the circumstance. Or whether activities of the foreign operation are financed from its own cash flows or by borrowing from the parent. If they are financed by borrowing from the parent, it would mean that it's an extension of the parent. So its functional currency might be the same as that of the parent. Right. So same functional currency as the reporting entity I have told you. Here it means they are merely reporting in the same functional currency. So all you have to do is to consolidate the usual way. But when it is different functional currency as that of the entity, if it's now different functional currency, you have to translate here. Where a foreign operation's functional currency is different from that of the parent, the financial statements need to be translated before they are consolidated. So this point is so important. And when you are consolidating, you follow these steps. These are the steps that you follow when you are consolidating a foreign operation. You know, we're about to finish. I'm just about to finish rundown of the handout. Step 1, translate the closing statement of financial position. By that we are saying all assets and liabilities using the closing rate. You now understand what a closing rate is. It's a rate which is prevailing on the date, at the date that you are consolidating. Meaning the year end date. If it's 31 December, it's a 31 December exchange rate. Then, so it's saying use closing rate and use this for preparing consolidated statement of financial position in the usual way. In other words, after you've translated the statement of financial position, it's now in dollars. You have translated it from a foreign currency to your currency now. So you can consolidate in the same way we discussed in earlier chapters. Subsidiaries, notice what you translate using closing rate are merely assets and liabilities. But subsidiaries, share capital, and pre-acquisition reserves are translated at historical rate, meaning the rate which was prevailing when you acquired your interest as a parent, the rate which prevailed on the date of acquisition, it's called historical rate. If that is the rate you use to translate share capital of the subsidiary and pre-acquisition reserves, not post-acquisition, pre-acquisition reserves. And then post-acquisition reserves are not translated, rather they are found as a balancing figure. Post-acquisition reserves are found as a balancing figure. In other words, you need to have what is called a translated statement of financial position. And when you have a translated statement of financial position, you shall see this. Assets and liabilities of that statement of financial position, you translated them using closing rate. Share capital and pre-acquisition reserves a different rate. So you shall notice that it will not balance. So the balancing figure then becomes the pre-acquisition reserves. Second step, translate the statement of profit or loss and other comprehensive income using average rate. So remember, the statement of financial position or balance sheet, we translate it using closing rate because it is as at. But you notice that share capital and pre-acquisition reserves, you use historical rate. But for statement of profit or loss, which is for the year, these transactions are spread throughout the year. So under normal circumstances, we use average rate, because it is not easy to use the rate which was prevailing today for sales and use another rate for tomorrow for purchases, for the day after for expenses and stuff. No, it's not possible. It's not practically convenient. So what we do is we translate using average rate. You translate using average rate if there were minor fluctuations. So average rate is usually given, so it's not an issue. If it's not given, average is the opening plus closing over 2. That is, if it's not given. Opening rate plus closing rate divided by 2, normally. But in most instances, it is given. But we know there is again dividend. No, now dividend is not paid throughout the year. No, like sales. Dividend doesn't accrue throughout the year like sales. To say sales for January, no. So dividend is not necessarily convenient to use average rate, because dividend is just is paid on a particular day. So the day in which dividend is declared or paid, make sure you use the rate prevailing on that day. Right? So after you have translated, you then have to calculate exchange gains or losses. So your statement of profit or loss will not be complete. You then have to calculate what we call exchange gains or losses, because here we call them exchange difference, because it's either a gain or a loss. So here's how you calculate exchange gain or loss. You say closing net assets at closing rate. Remember, net assets means share capital and reserves. You know that. Opening net assets at opening rate. And then you say less retained earnings is translated, and you then get exchange gain. I shall show you this as we are doing the illustration. All right? You get that? So let us now look at non-controlling interest. Non-controlling interest, you know what? They arise if you don't own a subsidiary 100%. So they are still valued using the same methods that we have used in previous chapters, meaning you value NCI using either, you can value NCI using either full goodwill method or a partial goodwill method. When it's full goodwill method, it means NCI has a share of goodwill. If it's a partial goodwill method, it means goodwill is owned by the parent only. That's partial. So you need to understand, because we are saying there are exchange gains and exchange losses here. So if you translate statement of profit or loss, the exchange gain that you get or exchange loss that you get here is shared between parent and NCI. It's shared between parent and NCI. Now let me show you how the case is when it's now it's now full goodwill method. But before I come to that, let me just mention something about exchange losses. So what I'm saying is exchange losses on translation of foreign operations net assets. They are shared between parent and NCI in terms of their ownership or acquisition ratios. So what then happens is the exchange gains or losses, you may say, where do we record them? Say we record them in other comprehensive income, in OCI. So they fall under what we call items which may be retranslated to profit or loss. As far as I'm seeing a raised hand.
Yes, sir. I just wanted to take you back. On the NCI, if it's full goodwill method, do we apportion any gains or losses?
Yes.
But if it's partial, we don't, right?
If it's partial, we still apportion gains or losses, but we don't apportion gains or losses on goodwill.
Oh, okay. Okay.
So either way, we apportion gains or losses, whether partial or full goodwill. But when it comes to exchange gains or losses on goodwill alone, if it's a partial method, we don't apportion. So
okay.
let me actually jump to goodwill calculation. so that I answer you and then say out whatever I wanted to say. So if you have something like this, if you have got a foreign operation, you still calculate goodwill in foreign currency and translate it. So it's not a train smash. We said all assets and liabilities of a foreign operation are translated at closing rate, right? So what it means is goodwill is also the asset of that foreign operation. You get it? Because we calculated it as an asset at acquisition. So it also follows the same way of being retranslated at closing rate, and there is either exchange gains or losses on goodwill. So let me show you. So as a general rule, you calculate goodwill in foreign currency like how we were doing it before. So notice, when I say F here, I just gave a dummy calculation of goodwill, meaning I put dummy figures and dummy exchange rates. So what you do, because it's now in foreign operation, remember you needed 2 columns to calculate goodwill from the notes, but now you need additional column for exchange rate and an additional column for the dollar sign like this, because our functional currency is the dollar. So we are translating from foreign to the dollar. So what you then have to do is you calculate goodwill first in foreign currency. So in this case, they are just say F1000 for foreign currency. So it is calculated as before, up, and goodwill came out to be 12.6, as you can see here. But this is because you acquired a foreign operation, it means we need to know goodwill at acquisition date in our dollars, because it's an asset, and initial measurement for any asset in foreign currency is that you convert it to your functional currency using the historical rate or the rate prevailing at the date of transaction. So there you go. As usual, you know, goodwill can be impaired. If you are told that goodwill was impaired, no wonder why I said if any here. Impairment loss goes to profit or loss, and you know that everything which goes to profit or loss is translated using average rate. So impairment loss, because it goes to profit or loss, you translate it using average rate. If the average is not given, you may use closing rate, but it's rare. If the average is not given, you may use closing rate to translate impairment loss. But whenever average rate is given, impairment loss, because it goes to profit or loss, you translate it using average rate. I was just giving dummy figures. All these are dummy figures. The exchange rate, I was just putting there. Instead of saying XXX, I realized that putting figures will make information clear. So you now have, after impairment, you now have unimpaired goodwill. Notice, unimpaired goodwill is now 10,600 here. So what you then have to do is, when you are preparing financial statements at 31 December here. So suppose they are being prepared at 31 March, and you acquired on 1 January, and you are now preparing on 31 March. What you then have to do, because it's goodwill is an asset, you translate it at closing rate, meaning the rate at 31 March. So there you go, 5,2. So the same goodwill in foreign currency is now 2,038. Notice there is an exchange gain here, because unimpaired was 1,700, and now it's after you retranslated closing rate, it's now 2,038. So this now gives you an exchange gain. Now, Fadzi, we're asking, how do we then? So there are 2 types of exchange gains. There is an exchange gain when you are translating foreign operations financial statements, and there is an exchange gain on goodwill. These are 2. There are actually 2 separate exchange gains. There's an exchange gain when you are translating foreign operation, get it right, which is calculated like this. I will show you with an example shortly here. This is called total exchange difference when you are translating foreign operations financial statements. This one, NCI is a share, whether it's a full goodwill method or partial goodwill method. NCI is a share on this one. Now, there is also another exchange gain. There is also another exchange gain, which is on retranslation of goodwill. This case, we are now talking of this. This one, this exchange gain, it's like you first find unimpaired goodwill and then retranslate it at closing rate to see. And if there is such a gain, who gets what of that gain depends on whether the group now uses full goodwill method or partial goodwill method, because this is to do with goodwill. So if it's a full goodwill method, this is shared between parent and NCI in accordance with their ownership ratios. If it's a partial goodwill method, NCI does not have a share on this gain. Are you getting it? So this is everything that I've written here. You know, can you imagine? Can you imagine? All you are seeing here, I typed it today. Everything. Okay, just imagine. Here. This is your handout. I started typing in today and I ended today. 29 March by 11 past 1 I was done. It shows you the effort I put to these things. Put quite a lot of effort. So this is what I was typing here when I said goodwill and fair value adjustments arising on acquisition of a foreign operation should be treated as assets and liabilities of the acquired entity, you notice. Meaning they have to be retranslated at closing rate every now and again. This means that they should be expressed in the functional currency of the foreign operation and translated at closing rate. Impairment loss on goodwill is translated using the average rate, though the closing rate may be used if the average rate is not given. The goodwill balance after impairment is the one which is then retranslated using the closing rate. Here is a layout of calculating goodwill. So I have just given you the layout. And I was saying, in this particular layout, I had used the partial goodwill method. Partial goodwill method says NCI is valued at its proportionate share of net assets. That partial goodwill method, that's what it means. When they are saying NCI is valued at its proportionate share of net assets, that's partial goodwill method. How do you tell that this is now, if you are told that this is partial goodwill method, how then do you value NCI? We are being told that NCI is valued at its proportionate share of the fair value of subsidiaries identifiable net assets. Meaning what you do, you first calculate net assets of the subsidiary like this. When you are calculating goodwill, you leave the NCI line blank. Here, you leave it blank. And first find subsidiaries net assets. After getting subsidiaries net assets, you then multiply, because it's proportionate share of net assets. So after getting net assets, you then say, if it's 90%, meaning NCI is 10%, you then say 10% of 66. You come and put it here. So important. So important. You remember this part. Okay, so there you go. We are done. It's now questions. Now, this concerning this particular, notice this was March, June 2019. If I am to open another paper, just for interest sake, because I opened two papers and then I realized I need to choose between the two. Just for interest sake, notice the same question was on March, June 2019. It was again on March 2020. March 2020 question paper. It's printed in something else. Notice here is March 2020 question paper. Draft an explanatory note to the directors of Hamins addressing the following: how the functional currency of crochet should be determined, how crochet's customer contracts should be accounted for in the consolidated financial statements, a calculation of goodwill of crochet in grommets, meaning in foreign currency, and how it will be accounted for in the consolidated statement of financial position as at 31 December. Include a brief explanation and calculation of how impairment and exchange difference on goodwill will impact on consolidated financial statements, how quiver should be accounted for, etc. So all these examiners, they like this standard. And if that was in this particular paper, and if you open as much questions, because I just downloaded these ones, I just wanted to find something for inclusion in this question, and then I opted for 2019 one. So you can right away note down March 2020 question paper and pencil it for revision as soon as we are done with this. Okay, so I'm reading the question. Background information. It says Cabais is a parent company of an international group which has a presentation and functional currency of the dollar. The group operates within the manufacturing sector. On 1 January 2022, Cabais acquired 80% of equity share capital of Bakelite, an overseas subsidiary. The acquisition enabled Cabais to access new international markets. Cabais transfers surplus work in progress to Bakelite, which is then completed and sold in various locations. The acquisition was not as successful as anticipated, and on 30 September 2026, Cabais disposed of its holdings in Bakelite. The current year end is 31 December 2026. Then Bakelite is based overseas. This is now Bakelite information. It is based overseas where the domestic currency is the dinar. Staff costs and overhead expenses are all paid in dinars. However, Bakelite has a range of transactions in a number of other currencies. Approximately 40% of its raw material purchases are in dinars and 50% in yen. The remaining 10% are in dollars, of which approximately half were purchases of materials from Cabais. This ratio continued even after Cabais disposed of its shares in Bakelite. Revenue is invoiced in equal proportion between dinars, yen, and dollars. To protect itself from exchange rate risk, Bakelite retains cash in all the three currencies. No dividend have been paid by Bakelite for several years. At the start of 2026, Bakelite sought additional debt finance. Cabais was already looking to divest funds. Funds were raised from an issue of bonds in dinars, none of which was acquired by Cabais. Acquisition of Bakelite. Cabais paid 100 million dinars for 80% of ordinary share capital, for 80% of ordinary share capital of Bakelite on 1 January 2022. The net assets of Bakelite at this date had a carrying amount of 60 million. The only fair value adjustment deemed necessary was in relation to a building which had a fair value of 20 million above its carrying amount and a remaining useful life of 20 years at acquisition date. Cabais measures non-controlling interests at fair value for all acquisitions, and the fair value of 20% interest was estimated to be 22 million dinars at acquisition date. Due to relatively poor performance, it was decided to impair goodwill by 6 million during the year ending 31 December 2025. The rates of exchange between the dollar and dinar are given below. So these are the exchange rates. Meaning on the date of acquisition, average during the year December 30 September 2026. Average for the 9-month period, etc. Disposal of Bakelite. Cabais sold its entire equity shareholding in Bakelite on 30 September 2026 for 150 million. Further details relating to the disposal are as follows. Carrying amount of net assets at 1 January 2026. Bakelite loss for the year cumulative exchange gains on Bikelight at 1 January 2026, non-controlling interest at 1 January. Now, these are at 1 January, but we are told that it was sold on 30 September, meaning some of the figures here need to be affected. They have to be addressed, to be adjusted as well. Now, required, prepare an explanatory notes for the directors of CABIs, which address the following issues. What is meant by entities presentation currency and functional currency? Explain your answer with reference to how presentation and functional currency of Bikelight should be determined. Are you not seeing this? This is 7 marks. So it's the same question. It's the same question. Let me download the March 2020 because I need you to see these side by side. I need to explain as broad as I can. Allow it to open the Chrome there. Right. SBR past papers. SBR International. Because I want it, because the manner in which it's downloaded, it's downloaded in a manner which is not ideal. Now this one, let me open it again and see. All right. Okay, so this one is a better paper than how it had opened there. There's a reason, because I viewed both papers before I chose, but I realized I can as well use this to illustrate some of the points which I couldn't cover everything in this paper alone. So I want you to see. What is meant by the entity's presentation and functional currency, and explain your answer with reference to the presentation and functional currency of Bikelight. Now, you notice that your exam is a computer-based exam, so this will be you'll be typing. And when you are asked to write an explanatory note to the directors, whenever you're asked to write explanatory notes for the directors of CABIs, it means you can't be explaining something to do with financial statements if you can't cite the standard. You need to cite the standard for you to explain something to do with financial statements. You get that? So on part one, I'm going to say it out because this video will be retained. So you can as well play the video over and over to get it out. You write explanatory notes to the directors of CABIs. And then you say determination, meaning and determination of both of presentation currency and functional currency. Because the examiner needs the two. So don't just mix the two anyhow so that the examiner will not know which one are you really talking about. Are you talking about the functional or presentation? So you then underline and say presentation currency. A presentation currency is the currency in which financial statements of an entity are presented. Then IAS 21, make sure you cite the standard. IAS 21, effects of changes in exchange rates. It requires an entity to present its financial statements in any currency of its choice. There's no the currency which the entity must present financials. No. It's any currency of its choice. So directors of CABIs have a prerogative. They can exercise their choice and choose any currency as its presentation currency. But that presentation currency must ensure that the primary users of financial statements, in this case, present investors, the currency in which equity and debt finance was raised, because you run the company with people's monies, and clearly you would present in the currency in which you got the money. You get it? So the currency in which equity and debt financing normally was raised is the presentation currency. So you are done on presentation currency. And then you look at functional currency. You define functional currency as the currency, of the primary economic environment in which this particular entity operates. That's the functional currency. Now, the business model of Kabais, you are being told the business model of Kabais is that it sells in both yen, dinar, and dollars. And then you are told that it retains cash flows in all the three currencies, meaning management has autonomy over the cash flows. But to say the functional currency is the yen, is the dollar, is the dinar, when it is dispersed like this, might be difficult. We are also told that raw materials, remember you are citing, it's important to cite from the case, don't use your opinion. You are also told, you are describing business model. You are also told that staff costs and overheads are in dinars. You get that? The staff costs and overheads are in dinars. And we are told that revenue is invoiced in equal proportion between dinars, yen, and dollars. So it's like 33% of each. And then you are also told that you are writing you'll be writing this. Bakelite is retaining cash in all the three currencies, meaning it has got autonomy over the cash flows. It's not an extension of the parent in this case. It has got an autonomy. So it has got its separate functional currency. But we are not told the currency which our competitors are also using. So determination of functional currency for Bakelite might be something like problematic. It might be problematic. So we need secondary information. What is secondary information? We now need to look at the currency in which finance is raised, the currency in which wages are paid. So we are told that labor costs and overheads are in dinars. And then, so what is left is currency in which wages are paid. So if you come to this question, you'd realize that, the currency in which finance is being raised. When you come to this question, they are saying, at the start of 2006, Bakelite sought additional debt finance. As Kabais was already looking to divest, funds were raised from a bond issued in dinars, and none of which was acquired by Bakelite, by Kabais. So we are being told here that when the company needed additional finance, it issued bonds in dinars. And these bonds were not even acquired by the parent. So we can reasonably conclude, that's how you'll be writing, reasonably conclude that the functional currency is the dinar. Full stop. Now, another thing that I want to make it clear now is the issue of the length of your answer. I have to make it clear now, because when you are revising, when you are doing questions, normally you'll be saying, let me check with the marking scheme and stuff, and you get the shock of your life if you open a marking scheme like what I have done here. Because what happens is a marking scheme will be of this length. Notice all this is for 7 marks on question number. That's question 1 alone. So don't be tempted to think your answer should be this long, because there's no way you can type all this to this extent and finish in an exam. There's no way. So don't make it a critical success factor that your answer should be to the extent of the marking scheme, because that one is called a marking scheme, meaning it is the examiner who is being told, and the examiner marks for a range of students. So the examiner is being told as broad the answer as possible to accommodate students. as many as who were trying to answer this question right. So you can't have your answer representing a broad range of students as a single student. On discursive parts of the question, normally the answer is broad because the examiner is being told, the marker is being told to accommodate. Some students may express a point this way, others this way, others this way. So it is broadened for that purpose. But from question practice, you can figure out by continuing, by doing a lot of questions, you can figure out that my answer is included therein. My answer is included therein. As a general rule, your paper has got 100 marks and 3 hours, meaning 1.8 minutes per mark. So if you are answering something for 7 marks, all you simply do is you say 1.8 times 7, meaning you should answer it in 12 minutes. Once 12 minutes lapses, go to the next question. Go to the next question. So don't have it, don't be, but for workings, for calculations, yes. Calculations, it must be an exactor. You make sure you get the same figures as the examiner got. Calculation, unless if they differ only by rounding off, because those ones are now scientific. But discursive parts, they are broadened as much as possible, like especially on the provisions of the standard. The examiner may be at length. So what you need to do is to apply the standard to the case quickly. In other words, don't waste a lot of time describing a standard which is different from the case. A standard has got a lot of things. So I am a director here. You are explaining to me how I can get the functional currents of bike light. Of course, all you have to do is to tell me that IAS 21 says this is what we look for when we are determining functional currents. And then you say applying these guidelines to bike light. Bike light, so you first list what the standards say are the variables to look for when you are determining functional currents. And then you then say applying these guidelines. So you then go by how are cells being generated. You now apply one by one. Cells are being raised in equal proportions of dinar, yen, and dollars. So there is no clear guideline on functional currents if you look at cells. We look at overheads, costs, and wages. These are in dinars. We look at raw material purchases, 40% in yen, the other in dollars, the other in another currency in dinar. So again, there's no clear cut there. There's no clear cut indication of which one is the functional currency. Then you look for secondary information. Secondary information looks at cash generated from operations. In which currencies are they being retained? They are still being retained in equal proportions of dinar, dollar, and yen. So we then escalate it further and look for how cash flows, in which cash flows from financing are being raised. And recently, we raised debt issue from dinar. So, judging by the secondary information, we can reasonably conclude now that dinar is the functional currency. Full stop. Imagine, I haven't typed everything like this. Where's my answer, by the way? Here. Just look on your screen. I haven't typed everything. I have just applied the standard. So by experience, you shall come to know that whatever you have written is included within the standard, within the answer. So you do notice again here, this was another question, 2020, March 2020 says how functional currents should be determined. So it's still 5. So this one was 7 marks and this one is 5 because this one said the presentation and functional currents. So it asked the 2. Continuing, we are on our bike light question. A calculation of goodwill on acquisition of bike light and what, so you are drafting an explanatory note. So this is an explanatory note which address the following. I need people who answer the question as said. It's an explanatory note which address a calculation, meaning which should provide the calculation of goodwill and what balance would be at 30 September 2026 immediately before the disposal. Your answer should include a calculation of the exchange difference on goodwill, 5 marks. So this one is a quick one. So when it comes to goodwill, I had showed you how it is calculated. Remember, just at the top here. First, calculate it in foreign currency using exchange rate prevailing at the date of transaction. If it was impaired, take out impairment at average rate and then retranslate the balance at closing rate to get exchange gains or losses. So this is what we are being told to do. So what I simply do is I'm calculating on acquisition of goodwill on acquisition of backlight. Sorry. Goodwill on acquisition of backlight. Now, you need what? You need dinner. We have now said it's dinner, meaning you have to. Now you may say, now if I had gotten the functional currency wrong, how was I going? You can tell the exchange rates which the examiner has given you. They are all to dinner. So you can even if you have gotten your function. This is another hint also. You know, if they give you exchange rates like dollars per dinner, they are giving you a hint that when you are concluding on which one is the functional currency, it is likely to be the dinner, because that's the currency where you are given the exchange rate. You can't say, oh, I can reasonably conclude that the functional currency is the yen. You can't say it's the yen when you are given exchange rates in dinars. So exchange rates in dinars, they are there as a clue that your conclusion should support the use of the dinar as the functional currency. You can't say yen if the exchange rates are in dinars. Can you imagine how shocking your answer will be? Right. So, okay. So you calculate it in dinars. In dinar, it's millions. I don't know how to. Is it millions of dinars or dinar millions? You know, millions. And then here you put exchange rate. And then you get it in dollars, millions of dollars. So there you go. All right. Right. So goodwill is calculated as what we know, guys. There's nothing much that you need to worry about goodwill. So you have got consideration transferred, consideration transferred. How much did we pay to acquire this particular subsidiary? So here you are. CIMA is paid 100 million dinars for 80% of the ordinary shares. I mean, of ordinary shares. So it was 100 million. So consideration was 100 million. Because we are told also that it uses full goodwill method. Here they are saying CIMA measures NCI at fair value for overseas acquisitions, and the fair value of 20% NCI was 22 million. So you then say add fair value of NCI, add fair value of NCI is 22 million. So there you go. And then you get a subtotal for this. All right. Don't worry about the exchange rate. We are getting there shortly. Then you say less fair value of net assets at acquisition. Less fair value of net assets at acquisition. Fair value of net assets. Fair value of net assets. Assets at acquisition. Less fair value of net assets at acquisition. So Net assets, you just look up in the information. We are told that the carrying amount of net assets was 20 and it was 60 million, and the fair value adjustment that was required was 20 million on buildings. So you are saying carrying amount here. So net assets at the carrying amount of 60. It's carrying amount of net assets. Carrying amount of net assets was 60. Oh, sorry. Yeah. And then there was fair value adjustment. Fair value adjustment concerning buildings. Fair value adjustments on buildings 20. So after we do this, we come up with goodwill. So this is 80, and goodwill equals 122 minus 80. So that's goodwill. Goodwill on 1 January X2. That's when we acquired it. And then the exchange rate. You calculate goodwill, and then you calculate you translate the goodwill at historical rate. It was $1 equals 0.5 dinar. $1 equals, so the exchange rate here was 0.5. Now, if you want to convert to dollars, you need to know, do I divide or multiply with this rate? Now, the exchange rate is already telling you that dinars are fewer than dollars. $1 equals 0.5 dinars. So you are being told that dinars are fewer than dollars. So if you are converting from dinar to dollars, you should get more dollars. It's there on the rate itself. Can you see that? $1 equals 0.5 dinars. The rate is telling you that dinars are fewer than dollars. So if you are converting from dinar to dollar, you must get more. And you don't get more by multiplying in this case. You get more by dividing. So you say equals this over this. So goodwill was 84 on the date. So this is how you go about it. And then the question says, you need to answer the question as set. The question is saying your answer, but they are saying goodwill balance at 30 September 26 immediately before disposal. Your answer should include a calculation of exchange difference from 1 January to. So we need to impair goodwill first. Goodwill was impaired by 6 million dinars for the year ended 31 December 2025. So you then say less impairment. Less impairment. Impairment in 20x5. Less impairment. It was 6 million. So here you take out 6. You take out 6. You say minus 6 like that. And then impairment, you convert impairment using average rate. So average rate for the year ended 31 December 2025 was 0.4. So you put 0.4. You use average rate for that year. So you take out like this equals this over this. That's your impairment. And then unimpaired goodwill. Unimpaired goodwill becomes, so there you go. If I add like this, I get my unimpaired goodwill like this. And then I then say I skip a line and say balance at 31 December 20x5. The balance was 36 on this date, and exchange rate, I use closing rate. Closing rate at 31 December is 0.38. So I use 0.38 like this. So I then say 36 divided by 0.38. Notice it's now 94, meaning it has increased from 69 to 94. So there is an exchange gain here. Exchange gain. Exchange gain is a balancing figure. A balancing figure. So the exchange gain equals 94 minus 69. So it is gained by 25. It is gained by 25 over this particular period. And then I then say, remember it was the company was disposed on 30 September. So I then say balance at 30 September x6, balance at 30 September x6, which was the goodwill balance at the date of disposal. It's still in D9, but I now have to find the exchange rate on that date. 30 September x6 was 0.35, so I put exchange rate of 0.35 here, and then I then say equals 36 over 0.35. It's 102.82. That's the goodwill. So it has again increased. So there's an exchange gain as a balancing figure there. The exchange gain equals 102 minus 94. So the exchange gain is 8. Are you not seeing this? So this is what they need. This is what is worth 5 marks. They are simply telling us to calculate goodwill and show the exchange difference on goodwill for the period 1 January to 30 September. So this is actually what they want. The other exchange gain we calculated here, 1 January to. So this exchange gain. Now let me read the next question. The next question says, remember it is still under the same explanatory note. So what you do is you do this in the workings, and then you say computations in workings 1 indicate that goodwill balance. That's what you simply do. You do this in spreadsheet, and then just say computations in workings 1, kind of working 1, indicates that the goodwill balance at 30 September 2026 was $102.86 million, and exchange gain recognized for the 9-month period 1 January to 30 September 2026 was 88.12 million. You are done. All this working, you don't put it in the Word document. Though you can as well, provided the examiner says it. Like here, the examiner is saying any workings can either be shown in the main body of the explanatory note or in appendix to the explanatory note. Meaning, you can work it something like this and copy it and paste it in the Word document. It's possible to just copy like this as it is and paste it in the Word document. You are done. And then an explanation of your goodwill, of your calculation of goodwill and the treatment of exchange differences in the consolidated financial statement. An explanation of your calculation of goodwill and the treatment of exchange differences in the consolidated statement of financial position. You do not need to discuss how disposal will affect exchange differences. 4 marks. Can you imagine what this question is saying? It is saying, tell us how you have calculated goodwill. Notice, any explanation of your calculation of goodwill. Meaning, this one now is the easiest question of them all. It is saying, after calculating goodwill, tell us what you have done. And I don't expect you guys to get this part wrong, because you are being told, tell us what you have done when you were calculating goodwill. So if you played last week's video, I told you how you calculate goodwill. You simply say, they are simply saying, your explanation, an explanation of your calculation of goodwill and how exchange differences on goodwill, and the treatment of exchange differences on goodwill in the consolidated financial statement. So I have my calculation here, I am just explaining this calculation. Please, I'm not doing anything else. And then I then explain how these exchange differences are treated in the consolidated financial statements. So it's a matter of saying like this: goodwill is calculated. You know, this is according to this is according to IFRS 3 business combination. Goodwill is calculated as the difference between the sum of notice, I am writing what I'm seeing here. Goodwill is calculated as the difference between the sum of consideration transferred and the fair value of NCI less the fair value of subsidiaries identifiable net assets. If carrying amounts, like in this case, CIMA's carrying amounts required a 20 million fair value adjustment to bring them to their fair values. CIMA's carrying amount of net assets or CIMA's net assets required a 20 million fair value adjustment, 20 million dinars, to bring them to fair values. Because Bakelite is a foreign operation, goodwill is calculated in foreign currency and then translated at each, it is initially translated at historical rate, meaning the rate prevailing when CIMA is purchased. Don't just continue to say parent, as if the parent, you don't know it. On the date when CIMA is purchased Bakelite. And then at any impairment of goodwill, like in this case 6 million, is translated at average rate. And then goodwill balance after impairment is retranslated at closing rate. And the balancing figure becomes the exchange gains. Now, exchange gains, they are saying the treatment of exchange gains. Because the group uses full goodwill method, the exchange gains are apportioned, the exchange gains on the retranslation of goodwill are apportioned between parent and NCI. Are we together? And then, for the year ended 30 September 2026, the exchange gain to be recognized in other comprehensive income, in consolidated other comprehensive income, is 80% of, it's 8.2 million, which is then shared between parent and NCI because the group uses full goodwill method. These previous exchange gains, like those recognized in 20X5, they are already included in equity because they were recognized in that year. So only the current year's portion of the gain is the one which is recognized in OCI. Are you getting that? Only exchange gains for this year are the ones you recognize in OCI. The exchange gains for previous years are already in the financial statement because they were calculated and recognized then. Okay, now another issue that I want you to know is that notice here consideration transferred was already given in dinars. But I noticed when I was going through March 2020 question paper, notice it is saying calculate goodwill of crochet in grommets. In other words, it's in grommets. It's not dinars this time. The foreign currency is grommets. But notice here, they are saying Cummings paid $24 million to acquire 80% holding in crochet. That's now the 2020 question paper. Are you noticing that the functional currency of crochet is grommets because you are given here as grommets? Now notice the functional currency is grommets on 1 January 20X4, meaning this is the currency that you are going to use. It's grommets. But you are being told that it paid 24 million. And I'm saying goodwill must be calculated in foreign currency. And here you are given $24 million, not grommets. So when you say consideration transferred, notice you don't say consideration transferred 24 million under grommets because these are dollars. So what do you do in your opinion? The exchange rate was 1:7. You are calculating goodwill in grommets. What do you do? Can you unmute and tell me? On consideration transferred, it was 1:8. Sorry. what do? You are given $24 million in dollars and goodwill, they require it in grommets. How do you calculate consideration transferred? Unmuted, talk to me.
I think you multiply 24 million with 8 grommets.
Yes, you multiply 24 million with 8 grommets. If you fail to do that, you get a huge negative goodwill and you get the shock of your life. And then another thing here is that I'm just saying what I noticed. I read through these questions, so it would make sense if I explain some of the things. I noticed this. You notice that it was also using fair value method, and then, right now, notice it was decided to impair goodwill by 30%. I'm sure you. Another thing is you are not given average rate here, but you are told that goodwill was impaired by 30%. Now that you are not given the average rate, I said you can use closing rate, meaning this impairment here, because they are saying at 31 December, meaning this decision was done at 31 December. So you can use 1 to 7 grommets. Now, on this particular question, this is the business model. The business model of this question is like this. The head office of Crochet is located in a country which uses dinar as its main currency. You know, the dinar, they like it so much. However, its staff are located in a variety of other locations. Consequently, I'm reading this part. Consequently, half of their employees are paid in dinars and the other half are paid in grommets. So half in dinars, half in grommets. Crochet has a high degree of autonomy and is not reliant on the finance from Hammings, which is the head office. Hammings is the parent. Nor do sales to Hammings make significant portion of their income. All of its sales and purchases are invoiced in grommets. All of its sales and purchases are invoiced in grommets. So are you noticing the competitive forces there? They are priced in grommets. The main activities, primary activities, are priced in grommets. And therefore, Crochet raises most of its finance in grommets. So even if we want to raise finance, we are raising in grommets. Cash receipts are retained in both grommets and dinars. Crochet does not own a dollar bank account. Crochet company is required to pay tax on profits in dinars. So clearly, you can reasonably conclude and say dinar is the functional currency. Now, acquisition of Crochet. So you now understand the first line here, the 24 million issue. Then Hammings company has a policy of measuring NCI at fair value. The fair value of NCI in Crochet was 6 million. Notice it was $6 million. And you need to calculate goodwill in grommets. So NCI, again, you have to multiply NCI to convert NCI from dollars to grommets by using the same rate here, 8. So important. Since Crochet has a range of net assets held domestically and overseas, the fair values of net assets were determined in their local currency. Hence, the fair value of some assets were determined in dinars and others in grommets. So in other words, when we were making fair value adjustments, some were in dinars, others were in grommets. So no wonder why you have a dinar exchange rate here. It's for fair value. They are saying the total fair value of net assets denominated in grommets was 43 million, and those denominated in dinars was 50. Remember, you are calculating goodwill in dinars. So I mean in grommets. So these ones, fair values in net assets. In grommets, you leave them like that. But these ones which are in dinars, you need to convert them from dinars to grommets. From dinar. Now it's saying 1 dinar equals 2 grommets. So if there were 50 million dinars and you are converting them to grommets, there will be 100 million grommets. You get that? Because of this exchange rate. 1 dinar, 2 grommets. So 50 million dinars becomes 100 million grommets. So I said I must show you this for you to understand that. No wonder why you are given a lot of rates there. But the functional currency is gromits because they are saying calculate goodwill in gromits. You get that? So it is possible for fair value adjustments to be in various assets. Those in 43 million gromits, leave them like that because we are calculating goodwill in gromits. But these ones which are in dinars, convert them to gromits. Another thing is NCI is $6 million and you are calculating goodwill in gromits. So multiply 6 million by 8. Purchase consideration, multiply 24 million by 8. I'm sure that's what I wanted to say concerning this paper. If I can close it for now, I'm sure I have said what I wanted to say. You can now do that paper on your own. Okay, so coming back to this, an explanation of your calculation of goodwill. You noticed it was a matter of just explaining how this goodwill was calculated and how you then treat exchange differences. So I have explained that part. Continuing. B, explain why exchange differences arise on net assets and profit or loss. Explain why exchange differences arise on the net assets and the profit or loss of Bakelite each year and how they should be presented within consolidated financial statements. Your answer should include a calculation of exchange differences which would arise on translation of Bakelite in the year ended 31 December 2026. Now it's 7 marks. They are now saying explain why exchange differences arise. They just want this part first each year and how they should be presented in the consolidated financial statements. That's another part. And another part, calculate the exchange differences for the year ended 31 December 2026, excluding exchange differences on goodwill. Why are they saying excluding on goodwill? Because on goodwill, we have already calculated. We have already calculated exchange differences on goodwill. So that one is a done deal. Now, how really, I told you that whenever you translate assets with different exchange rates, there's an exchange difference. It's logical like that. But then you are writing an explanatory note to director. So let me put it in a manner you will write it. You put it like this. The financial statements of a foreign operation must be retranslated from the functional current to the presentation of the parent, or to the presentation current of the parent each year. They have to be retranslated each year. And the exchange rates differ from year to year. Assets and liabilities are translated at closing rate, and profit or loss items are translated at average rate, and these rates, they differ. Now, the exchange differences, they then inevitably arise as a result of retranslation of statement of financial position at different exchange rates each and every year. The exchange differences arising from the translation of foreign operation are apportioned in the consolidated statement of financial position. They are apportioned between parent and NCI in accordance with their ownership ratios. They are recognized as other comprehensive income in the statement of profit or loss. Now, there's something that I want you to know. Exchange differences, they don't just arise because of difference in exchange rate. They are also adjusted by profit or loss made by the foreign operation during the year. For me to show you this particular aspect, allow me to scroll back to the notes on how exchange differences are calculated so that you can see. Right. Notice, this is how exchange differences arise. And this is what the examiner is saying. Explain why they arise. You are simply saying, net assets of the foreign operation are translated at closing rate at closing rate for each and every year. And these closing rates, they change, they differ. Like there is closing net assets at closing rate and opening net assets at opening rate. So these rates differ, resulting in an exchange difference. Now, the exchange difference is then adjusted with profit which was made during the year, because profit or loss is included in the net assets. And this is translated at average rate. So there are two things which account for this difference. This difference, because these are net assets, if you make a profit, net assets will change, will increase. If you make a loss, net assets will decrease. So net profit or loss contribute also to this difference. But it doesn't cover the entire difference. The remaining difference is then attributed to exchange rates. You get that? You are done with that. Then they are saying include a calculation of the exchange difference. So we are going to use this template. Include a calculation of the exchange difference for the year ended 31 December 2026. So if you want to, so we are now saying exchange differences, exchange difference for the year ended 31 December 2026. Now, here's how you calculate exchange differences. What I want you to know first is for you to know opening. Let me say in dinars first. Opening net assets. Opening. Let me start by having some workings. Some workings first. We have got opening net assets. Opening net assets. Remember, we acquired this company here, 20x2, and the buildings which had a fair value adjustment, we are told they had a life of 6 years, now of 20 years. Now we dispose the assets. We dispose the assets after 4 years, which is 20x6. So this building then is depreciated for. This building has depreciated for 4 years, meaning 20x2, 20x3, 20x4, 20x5. So by end of 20x5, it is depreciated for 4 years. So opening net assets of this particular company for 20x6, what you then have to do is, are we given these in the question? Opening net assets. Oh, sorry, let me scroll down to the question and see. Carrying amount of Bakelite's net assets. Are you not seeing? We are given them as 48 million dinars. But remember, 48 million dinars, it excludes fair value adjustments. So you say D48 million plus fair value adjustment, because fair value adjustment is not included in the assets of a subsidiary. It needs to be done as a consolidation adjustment. So it will be fair value adjustment was 20 million less depreciation from X2 to X5, less depreciation from X2 to X5. So you get what? It was now 16, because it depreciated for 4 years. It was 20 years straight line, so it's now 16. So there you go. So you now have 48 plus 16 equals 48 plus 16. Then closing net assets. So it's 64. Then closing net assets. Closing net assets. Closing net assets. Notice you started with 64 opening net assets. 64 opening. You started with 64 million, and then you made a profit we are told here that loss for the year was 8 million. This was loss. So you say less 9 months loss, less 9 month loss, 9 months loss. Now 9 months loss, you are simply saying it's 8 times 9/12, because you disposed on 30 September, 8 times 9/12, and then you say less 9 month depreciation, 9 months depreciation on fair value adjustments, which is, remember, the building had a life of 20 years, it was 20 million. So it is 1 million times 9/12. 9/12. So what then do you get is 1 million times 9/12. What I'm getting here is I'm getting 64 minus 8 times 9/12, that's 6, minus 0.75, right? Minus 6 minus 0, I'm getting 56. These are dinners, millions, dinners. Right. I just wanted you to know how these figures are calculated. So you can now say NB. You can't write NB in a report. I'm putting it because you shall play the video. So 9 month loss to 30 September x6. 9 month loss to 30 September x6. It will be negative 6 million plus minus depreciation, which is negative 0.75. So the loss that you have is minus 6.75. So this is the loss. Because if you are subtracting depreciation from a loss, it increases that loss. So now let us now calculate exchange differences. Let me cut this and paste it. Exchange differences now for the year. Here is how you then calculate them. You say opening net assets at opening rate. So it's like this. Opening net assets, opening rate. Always know that exchange differences are calculated in dollars, in presentation currency of the parent. We don't calculate exchange differences in dinar. Imagine we are translating dinar to dollars and you are calculating exchange difference in dinar. Is it still a difference if it is still in the same untranslated currency? We are converting from dinar to dollars to see the exchange rate movement. So you can't see it in dinars. If you are converting from dinars to dollars, exchange difference is always in the functional currency of the parent. So exchange difference, opening net assets at opening rate. So opening net assets were 64. You now know them from above. At opening rate, what was the opening rate for 20x6? You know, the rate at 31 December 20x5 is the opening rate at 1 January 20x6. So it's 64 divided by 0.38. That's opening net assets at opening rate. So there you go. Oh, sorry. 64 divided by 0.38. All right. So yes. So I come here and say equals 64 over 0.38. That's opening net assets at opening rate. They give me 168.42. Then I say loss for the year loss for the year. Loss for the year is translated. Loss for the year is translated at average rate. Average rate. Now there was a loss for the year, and the loss was 6,75 divided by average rate for 9 months to 30. No wonder why you are given average for 9 months to 30 September, 0,37. So you translated 0,37. So there you go. You say equals 6,75 divided by minus 0,37. Notice. So there you go. After you have taken out the loss, your exchange difference was undo. I wanted to put a line here like this and then add. You are supposed to be at this point. You are supposed to be at 150. And then you skip a line and say closing net assets. Closing net assets. Closing net assets. Net assets at closing rate. Closing rate. Now these are now net assets, meaning net assets that are closing 57,25. You know, the figures that we have calculated there at the top, 57,25 over closing rate at 30 September was 0,35. So over 0,35. So what you then get is equals this over 0,35. So closing net assets are now what? 163. So what is now, you know, you started your year with 168. You made a loss of 18. So you were supposed to be at 150. What then increases them to 163? It is the exchange gain. There was an exchange gain. That's how you calculate it. It's a balancing figure. No wonder why they say your answer should include exchange gain for the year. So this one is a balancing figure. Let me highlight in yellow and explain again. Your net assets were 168 million. You made a loss of 18, so they were supposed to be at 150. But now they are at 163. What has increased them from 150 to 163 is the exchange rate movement now. Putting the loss aside, it's now the exchange rate movement. So this, no wonder why they said your answer should include a calculation. So that's what they needed. That's the 7 marks here. So it was a matter of telling the examiner that they were saying, why is it exchange rate difference arise every year? It's because net assets of the foreign operation are translated at closing rate for each year. And these rates are not the same, resulting in exchange rate movements. But the exchange rate movements are adjusted with the loss or profit for the period. And this is translated at average rate. Now, any resultant exchange gain or loss is then apportioned between NCI and the parent in the consolidated statement of financial position, and it is recognized in other comprehensive income. So the exchange gain for the current year only is recognized as the exchange gains for previous years. Exchange differences for the previous years have already been recognized in those previous years. Then they are saying calculate the group profit or loss on disposal of backlight. Calculate the group profit or loss on disposal of backlight, 3 marks. You then dispose a subsidiary. Now, when you dispose a subsidiary, it's easy. You played the previous week's videos, and I understand you are following me on this one because it's we are taking from what you already know from previous week. So you are saying group gain or loss on disposal of by client. Group gain or loss on disposal of by client. Gain or loss on disposal of by client. You know how to calculate group gain or loss? Because this is group gain or loss, obviously it's in dollars. It's no longer in dinars. No, it's in dollars. I gave you template on how this is calculated from previous week's video. Please play the video on illustrations. I send it in the group. Make sure you play that. Make sure you play that. Otherwise, these things will not. So you say consideration received or sales or disposal proceeds. Disposal proceeds. I always want consideration received, but it makes sense also to just say disposal proceeds. Now, how much did we receive? The disposal proceeds were 150 million dinars. Here you are. So it disposed its entire investment for 150 million dinars. So it's 150 million. Now, if the investment was not entire, you would say fair value of remaining interest. Fair value of remaining interest. If there was any remaining, but this time there's nothing, so I'm going to put 0. But in an example, there was no need for this line. I'm just illustrating. There was no need for remaining interest because we disposed the entire investment. You get that? And then you say less net assets at the date of disposal, less fair value of net assets at date of disposal, which is 30 September X6. That's date of disposal. Now, we have already calculated them. Notice. So we say net assets. Net assets. We have calculated them here. They are already, no, these ones are the net assets. So it was 163,57. We calculated them above here when we're calculating exchange difference. And then you then say, after saying net assets, you then say less NCI in net assets. Please play the video on groups. I told you how this is calculated. That's what I'm just doing here. Less NCI in net assets. Now, NCI, what NCI figure do we have? We are given NCI at 31 January. So in other words, we need to calculate NCI at 30 September. So we have to calculate NCI at 30 September. So what we then do is even exchange gains. Okay. Then you say less accumulated exchange differences. Accumulated exchange differences, because you are now disposing the subsidiary. So all accumulated exchange differences are then reclassified to profit or loss. In other words, we deduct them from net assets or from equity. Remember, all exchange differences were being recognized in other comprehensive. When you dispose the subsidiary, accumulated exchange differences relating to that subsidiary is also derecognized. Let me simplify it for you. You know, when you dispose an asset, accumulated depreciation on that asset must be removed also from accumulated depreciation. You know that? If I dispose an asset and there was accumulated depreciation in the assets of that asset, I should remove accumulated depreciation of that asset because I have disposed it. In the same way, if I had a subsidiary with accumulated exchange differences and I then dispose it, I should also do away with accumulated exchanges on that disposed subsidiary. And I do that by transferring them from equity and reclassifying them to profit or loss to remove them from my equity. All right. So that is the logic when I'm saying less accumulated exchange difference. So NCI net assets, let me say it's working. NCI net assets, let me say it's working 1. I want to put some workings there. Accumulated exchange differences, it's working 2. No, accumulated exchange differences, I can open a bracket here and say, you know, the exchange differences that I'm given was 74,16. So I am saying 74, they are already in dollars, 74,16. Then I say plus exchange gain, exchange gain on goodwill. Now, exchange gain on goodwill, I calculated it above. I'm just taking for this year. It was 8.12. We found it on goodwill here. It was 8.12 for this year only, because we are already given exchange gains at 1 January, meaning for the previous years they are already accounted for. We just need for the 9 months. So for the 9 months we have an exchange gain on goodwill, and we also have an exchange gain on net assets. Then exchange gain on net assets, exchange gain on net assets, The answer that you get is you get 74,15 plus 8,12 plus net assets here, the exchange gain on net assets, which we've just calculated above there, it's 13,39. And if you add all this plus 13,39, I'm getting 95,66. So equals 95,66. I then multiply this by 80%, because it's apportioned between parent and NCI, 80%. So what do I get? It's apportioned between parent and NCI. So I'm getting equals minus 95,66 times 0.8. Then you then say less another thing, you say goodwill disposed. Now, because you have disposed, so you take out goodwill, and goodwill in dollars, we have calculated goodwill already. Goodwill disposed is there in dollars here, 102,86. That's the balance at the date of disposal, right? So after you've done this, you can now calculate. Here you put equals sum of this through to this, right? So I need to have working on NCI. So I say working one. I then say carrying amount of NCI, at 30 September x6. So what is the carrying amount of NCI at 30 September x6? I then say balance at 1 January x6. So I'm given the NCI balance at 1 January x6 to be 47,8 here. At 1 January, I'm given balance is 47,8. And then I then say share of loss for the year, share of loss for the year. Now, I am working, my workings are now in millions of dollars. So the loss I take is the translated loss. It was 18, so it was, so I translate the loss like this, share of loss for the year. Remember, loss is 6,75. I translate it with average 0,37, and then I multiply by 20%. You get that? So equals minus 6,75 divided by average for 9 months 0,37 times NCI's share 20%, right? So it's 3,65 like that. And then I say add share of exchange loss, exchange gain on goodwill, is full goodwill method, and on net assets. Notice it's on goodwill and on net assets because it's a full goodwill method. So we take for this year only because that is what we yet to account. Other exchanges are already given in accumulated exchange gains, so they are already accounted for. 1,12 plus, that's on goodwill. On net assets, we calculated it as 13,39. Then NCI share is 20%. So you come here and say for this year, because we are given opening balance, meaning all the other balances are already catered for, 8,12 plus 13,39, close brackets, times 0.2. Right. So there you go. And then NCI's figure that we then get, because we need NCI at the date of disposal. So a carrying amount of NCI at the date of disposal becomes 48,45. So there you go. So what you are simply going to put here is equals 48,45. And then you calculate, all right. Oh, sorry, it's less NCI, so this one is negative. It's minus 48,45. Then you do this and calculate gain or loss on disposal. So there was a gain on disposal, gain on disposal of equals 150 minus 141, which is 8,55. So this is what they want us to calculate. That's the 3-mark part of it. Then last but not least, which is, remember I said hang in there, guys, because we want to, if we can today prepare for us to finish it tonight. I just want to do all these questions, and if you exit, we run the risk of our video being disjointed. So far, I implore on you to hang in there until we finish. And Tafar, make sure you hang in there until we finish. Is that Tafar? Let me check. Chipo, sorry. Hang in there until we finish, Chipo, because we don't want interruption on our video. You then play these videos at your own leisure. You get it. So that is the beauty of it. You then play these videos at your own leisure to actually get it. So because I don't want to rush my explanations. Now here is the deal. You have noticed something on this particular question, that it was an entire disposal. There was no remaining interest. If there was remaining interest, it can be treated as an associate or as what? Now we need to understand how then do we treat, because we disposed it. So question number D2 then says, briefly describe how bike light should be presented in the consolidated financial statements of Kabais for the year ended 31 December 2026. Now, bike light, we disposed it. So we can now say treatment of bike light of bike light in consolidated financial statements for year ended 31 December X6. Here is how you light for the year. You know what you need to do is you say in the statement of financial position, don't consolidate as the subsidiary is no longer there. Don't consolidate as the subsidiary is no longer there. We no longer have the subsidiary. You get that? And then in the consolidated statement of profit or loss. So this one is consolidated statement of financial position. Now in the consolidated statement of profit or loss, remember it was a subsidiary for 9 months. So consolidate bike light for 9 months. Bike light for 9 months. For 9 months to 30 September X6. Consolidate bike light for 9 months to 30 September X6. And then you also need to consider whether bike light constitutes a discontinued operation. Also consider whether bike light constitutes a discontinued operation. Now, I'm sure you did this in your earlier studies. If you dispose an entity, a division, a subsidiary, a branch, you need to understand whether it constitutes a discontinued operation. Why? If it constitutes a discontinued operation, it needs not to be. So it needs not to be consolidated. What do you look for? Look for this. For you to tell this whether this is a discontinued operation, you consider whether bike light constituted an operation. Bike light constituted an operation in a separate geographical area. That is one thing you look for. When we dispose the bike light, does it really constitute an operation in a separate geographical area? Meaning the area in which the market in which bike light was operating, do we still have operations there? If the answer is yes, it means it was not a separate geographical area. Two, whether bike light was a major line of business. You need to know if yes to the above. If yes to the above, then bike light is a discontinued operation. Bike light is discontinued operation. It's a discontinued operation. Now, once you realize that bike light is a discontinued operation, You then need not to consolidate it. You disclose it. You get that? Then don't consolidate. Don't consolidate, but disclose it. Don't consolidate, but disclose it. Disclose it as such. You disclose it as a discontinued operation. Now, when I'm saying you disclose it as a discontinued operation, here is how you present the results of a discontinued operation. Presenting, this is not part of the answer now because I'm teaching. I would then have to tell you, presenting the results operation of a discontinued operation. Here is how you present the results of a discontinued operation. What you do, you say statement of profit or loss. Statement of profit or loss. Now notice the requirements for a discontinued operation is that what you have disposed must constitute a major line of business. In other words, this you use judgment to say if it constituted 10%, 20% of your revenue, is it major? Clearly, if you dispose something which constitutes 10% of your revenue, it's a major line of business. You can't say it's a small line of business. So you say continuing operations. Continuing operation. This is how you then disclose. You say continuing operations. When you are preparing financial statements, you say profit or loss, and then you say continuing operations. So you say revenue, dash. You don't consolidate a discontinued operation. Then you say cost of sales. You know the usual thing. Then you proceed doing the same. Proceed up to profit from continuing operations. Profit for the year from continuing operations. And then that's how you do it. Then you say profit or loss from discontinued operation. Profit or loss from discontinued operation. Discontinued operation. Profit or loss from discontinued operation. That's now backlight. It's either profit or it's a loss. Profit or loss from discontinued operation, and then you get profit for the year. Profit for the year. You get it? So this is how a discontinued operation is presented. You don't consolidate. You present it like this. So for a discontinued operation, we only need one line here. If backlight satisfies the criteria to be included as a discontinued operation, we only need the line shaded in red. The line in red is what we want containing backlight. We no longer need you to say revenue of backlight plus revenue of carbide. No, you calculate profit or loss for the 9 months of backlight and then just bring in one line for profit. If it's a loss, bring in that loss. In this case, it was a loss, so it will come there. But it only comes here when it meets the criteria for classification as a discontinued operation. It doesn't just come presented like this. It must meet the criteria for classification as a discontinued operation. So you split continuing operations and then you calculate profit. You do whatever you do, cost of sales, expenses, etc. Up to profit for the year, and then you adjust with profit or loss from the discontinued operation. You get it? Right? And then notice the criteria for classification as discontinued. It must represent a major line of business. So this is a professional judgment which directors have to make. And then it must constitute an operation in a separate geographical area. In other words, after closing Bike Light, do we still have operations there? If the answer is no, it means Bike Light was a separate geographical area. If the answer is yes, it means Bike Light is not a discontinued operation because we still operate in the market in which Bike Light was operating. So what is a discontinued operation? A discontinued operation is a component of an entity, a branch, a division, or a subsidiary which have been sold or classified as held for sale, and it must constitute an operation in a separate geographical area, and it must be a major line of business. These two conditions must be met for it to be classified as a discontinued operation. Okay, as you can see, I'm explaining. And with this explanation, can't you get all the 30 marks? Can you talk to me? What can stop you from getting the 30 marks?
Nothing, sir. With proper revision, nothing.
Yes, there's really nothing, because examiners, they don't give you a lot of questions which give you problems. No, they know you can do it. They know you can actually do it. It is that confidence which I want. As you say, you can see I'm working everything out here. And you, as my student, you must be like you say. So now continuing. Last part, with this one we will be quick, don't worry. Henley acquired 70% of SAR, meaning this is a subsidiary, for 4,500 units. In other words, the foreign currency is just called units. On 31 December 2024, when the retained reserves of SAR were 1,125. No impairment losses have been necessary up to 31 December 2027. Neither company paid or declared dividends during the year. The group's policy is to measure NCI at their proportionate share. So that one was a full goodwill. This one is a partial goodwill. No wonder why I put it here. Okay, so you are given exchange rate movements, simple there. And then statement of financial position of Henley and SAR, you are given there. And then statement of profit or loss, you are given there, and then required. Prepare consolidated statement of profit or loss and a statement of financial position for the year ended, and a statement of changes in equity for the year ended 31 December 2027. So I just put here, because this is no longer write an explanatory note, it's now about preparing the actual financial statement. So it's for practice. It's for practice. So let me answer this particular question. So this is the Henley Group. In there, guys, I will try to be a bit pacey because I know I've already explained all the concepts, so it's now easy for me. Now, we told you that when you are preparing consolidated statement of financial position, you translate assets and reserves of the, assets and liabilities of the subsidiary using closing rate. So we do have these companies. So it's, you say consolidated statement of financial position as at 31 December X7. Now consolidated statement of financial position as at 31 December 2007. You have two companies. You have Henley, then you have got SAR, then you put exchange rate here, and then here you then say consolidated, like this. Now, yearly it's in dollars. SAR it's in units. Then exchange rate, then consolidated, it will be in dollars. So this is a schedule or working that you come up with when you are preparing consolidated financial statements when there's a foreign operation, because you first need to translate that foreign operation for you to consolidate. So now, Fadzi, I want you, because I want to type, can you just open this and do you have this one open with you?
I have it printed, sir.
Okay, yeah, perfect. So because I want to copy everything there to that particular. So can you read it for me in the interest of time? We have got what?
PPE.
Huh?
4,500. Oh, I'm going down.
Oh, okay, give me the figures. It's still fine.
4,500 and 4,000.
And 4,000, good.
Investment in SAR. Investment in SAR.
Investment in SAR.
Yeah, and then under that there's current assets.
Or investment in SAR is how much?
1,000.
1,000. Current assets.
2,400.
Current assets 2,400. And
in SAR 3,000.
3,000. Okay. And then we have total, right?
Yeah, 7,900.
Okay. Let me just use the formula for the total. I am getting 7,900 and 7,000.
Yes.
And then
share capital.
All right. Share capital.
2,000.
Share capital 2,000.
And 2,250.
2,000 and 2,250.
Reserves.
Now, reserves, because we want to translate reserves, I said you need to split now. You then have to say on reserves, you have to say pre-acquisition reserves, because they are translated differently. Pre-acquisition reserves and then post-acquisition reserves. The examiner will give you combined like this, but in the notes you are told that the pre-acquisition reserves were so much. So post-acquisition, right? So give me for Henley, what do we have?
4,400.
400, yes. For SAR?
4,400.
Oh, okay. Then for SAR now needs to be split between pre and post. We are given that in the notes. We are told that when we acquired SAR, retained earnings, retained reserves were 1,125. So SAR, we need to put 1,125 under pre, and then the balance. The balance becomes what? Because it had reserves of 3,950. So the balance becomes equals 3,950 minus 1,125, like this. So 2,825 are now post-acquisition reserves. And then we skip a line. What else do we have?
The totals.
We have the totals. All right, let me put the totals. Okay. All right. 6.4 and
6.2.
And 6.2, correct? And then
loans.
Loans.
1,500.
1,500.
And 800.
And 800.
Yeah. And
we are
total.
Done.
Yeah.
Okay, perfect. So this is schedule when you are preparing financial statements. This is what you do. This is actually the practical part of it. You do it like this. When we were saying translate now, we said we translate assets and liabilities using historical rate, meaning assets and liabilities of the subsidiary. We translate them using closing rate. Sorry, I had said historical. I meant closing rate, meaning the rate which is prevailing on the date we are preparing financial statements. So we are translating them using 31 December rate, which is 4. So what you are doing is you are going for every asset and put 4 like this, and put 4 like this. Asset and liability, and then here put 4. So, and then share capital and pre-acquisition reserves is translated using historical rate, meaning the rate which prevailed when we bought. So we bought when the rate was 4,5. So you come here and put share capital 4,5. Pre-acquisition reserves 4,5. And then post-acquisition reserves are not translated per se. We get them as balancing figure. Balancing figure. I told you this. So we now have a, okay. So what we then have to do, I need to put another column here, insert. We now, let me insert it. Okay, it's okay though. We now have to, okay, ignore the information at the top. We now have to say SAR dollars, just to ensure that we now have a translated. So it will be like this, divided by 4, like this. That equals 3,000 divided by 4, like this. Equals this 250 divided by 4,5, like this. Equals 125 divided by 4,5, like this. And then this one you don't. And then here you say equals 800 divided by 4, like this. All right. So we now have a translated statement of financial position for SAR. So what we simply do now is to balance it off. So its total is 1,750. So here should be 1,750. No wonder why I was saying post-acquisition reserves are obtained as a balancing figure. Post-acquisition reserves. Now, which figure do you need to put there? You then say equals 1,750 minus every other figure here, minus this, minus this, minus this. Right, so it's coming out to be 800. This is what I mean by saying the post-acquisition is obtained as a balancing figure. So the figures in yellow are no longer required. We now have 2 balance sheets in dollars. So we can now consolidate. PPE, we consolidate. We say dollars here plus dollars there. You get that? Current assets. Remember, investment in SAR is not consolidated because it's an intercompany thing. Current assets, that one plus that, you put it there. And then you put the total. And then you also do the same here. Share capital, remember to take parent only. Share capital, you take parent only. You remember that? Post-acquisition reserves, we are yet to work this out. And then loans. Let us work loans. Plus this. Right. Now, because this is we acquired a company, there's now need for these workings. We need to put working for Goodwill. Working 1. We now need to put working for NCI. Where do we put NCI here? Non-controlling interest. Non-controlling interest. Working 2. You get that? So we now need these 2 workings, or we can retained earnings. Here on retained earnings, we can put working 2. So let us put working 2 on retained earnings, and then working 4 on NCI. because the other working we need to do is the working on exchange gains or losses. Now let us have our workings. Let us finish them all at once. Workings. All right. One. You now know this, so I am a bit past. Goodwill. Goodwill. You calculate goodwill in foreign currency and then retranslate it. You now know that. So we have got, this is our working one. This is our working one, goodwill. So you say units, then units, and then you say exchange rate, and then you say dollars. So there you go. Units, units, exchange rate, and then dollars. So one by one in 10. You say consideration transferred. Consideration transferred. Consideration transferred is the investment in SAR. So it's 1,000. You calculate it. You calculate it. No, this is in dollars. So you need to take consideration transferred in foreign currency, which is 4.5. This one. So consideration transferred for 500. Then you say value of NCI. Value of NCI, because we use partial goodwill method, we leave it blank for now because NCI is a share of net assets. So we must first get net assets. You get that? You must first get the net assets. And then you say less fair value of net assets. Fair value of net assets at the date of acquisition. Now, the fair value of net assets, you take share capital and pre-acquisition reserves. You say share capital. Everything, you already have it from this working. Share capital is 2,250. You are taking figures in foreign currency. Reserves, it's 1,125. What was obtaining at acquisition? And you add this to get their sum. You say equals this plus. Remember, check reserves, you take what was there at acquisition. Now, NCI is a share of net assets. So we acquired only 80%, 70%. We acquired SAR 70%. It means NCI is 30% times 3,375. Are you not seeing how we go about it if it's a partial goodwill method? Because 0.3 times this. So what you then have to do is to calculate goodwill. So we now have goodwill here, which is equals this minus this, right? 2,135. This was goodwill at date of acquisition. So this is goodwill at 11x4. But we are now preparing financial statements at 11x5. So you say goodwill. You then say balance. If it was impaired, you impair 31 December x7. You now understand this part. There was no impairment, so there's no need. Now, historical rate, all these are converted using historical rate, the rate which was prevailing on the date of purchase, like this. Like this, 4,5. Like this, 4,5. Like this. Now, because we are now preparing a 31 December x7, we now use closing rate, which is 4. That's closing rate. So closing rate, you then say equals this over 4 over this. So it's now 534. That's the closing rate. And then historically it was this over 4,5. So notice there was exchange gain balancing figure. There was an exchange gain on a retranslation of goodwill. It's just a balancing figure, equals 534 minus your goodwill balance at acquisition, which is 59. And then this you can have 1,000 there. NCI was equals to this over this. You can actually have your figures like that, equals this over this. Okay, so you can say you can have your figures as well in dollars. It's equally important. It's equally convenient also, because you still need to work NCI carrying amount, so you need value at acquisition. So there was an exchange gain. So there you go, and then you go to consolidated profit or loss, working to consolidated statement of profit or loss, consolidated statement, consolidated reserves. Let's say consolidated reserves. Sorry, consolidated reserves. We have got two companies here. We have got Henley, and we have got SAR. This now, you just, they are now in dollars because you are working consolidated reserves. So obviously this is now in dollars. You say balance at reporting date, balance at reporting date, that's how we calculate. Now you have balance at reporting date. For Henley, it's 4.4. It's in the balance sheet above here. For SAR, the Henley is 4.4. For SAR, you take these two consolidated, translated figures, because they are all in the statement of financial position. So it's a balance at reporting date. So it's 1050. So for Henley, 4.4. For SAR, remember we splitted it into pre and post, but it's the same figure. So for SAR, you take 1050 here, 1050, and then you say less pre-acquisition reserves, less because pre-acquisition are not your reserves. You take them out. You take translated minus 800, which we got as balancing figure, and then what you then have there becomes post-acquisition. You then have post-acquisition 250. That's post. No, pre-acquisition it's actually 250. It's not 800. Pre-acquisition is the 250, and then post-acquisition. Is that so? Pre-acquisition 250 from the translated? Yes, it's 250. And then you say post-acquisition, and then you say group share. Remember, group share is 70% of this. The balance goes to NCI, so equals this times 70%, 560, and then you say exchange gain on goodwill, exchange gain on goodwill is there in our working one, in goodwill working. So because it's partial goodwill method, everything belongs to the parent. So the whole gain belongs to the parent. And then you add to get your reserves. Simple as that. That's consolidated retained earnings or reserves. And then you come to NCI, non-controlling interest. That's working 3. Before working 3, let's say, yes. So there you go. Let us say non-controlling interest. It's working 3, not 4, working 3. You say value at acquisition. Acquisition. Our NCI value at acquisition is this NCI at Goodwill or on Goodwill working in dollars. So equals 225. There you go. And then you say share of post acquisition reserves. Post acquisition reserves. It's just 30% times 800. So you get 240. If you add this becomes the carrying amount of NCI. Now with these 3 workings, you can now complete your consolidated statement of financial position. It's now complete. It's a matter of saying Goodwill. You come to Goodwill and say equal. You take your Goodwill figure here, the closing balance in dollars. There you go. NCI, reserves, you come to post acquisition, which is your working 2. So you then say it's 5109. There you go. NCI, you come to your working 3 equals. You come to NCI working 465. Enter. Then try to see if this balances. You then say there 9184,38. That's what I'm having here. 9184,38, and I balance this, total them 9184,38. So I'm done. My statement of financial position is balanced. Are you noticing, like in this particular case, NCI is no share. NCI is no share in Goodwill. So if NCI had a share in Goodwill, we would say share of exchange gain on Goodwill, like what we did in the previous question. Now, let us now have consolidated retained earnings, consolidated statement of profit or loss, consolidated statement of profit or loss. Statement of financial position is done. Statement of profit or loss. Consolidated statement of profit or loss. So there you go. It's again for the year ended. I'm not lazy. 1 December 7. I am not lazy at all. Notice how I pay. I am attentive to detail. I don't give up so easily. And I like your character and attitude. You guys, you are hanging in there. I know it has been long. Copy. So you copy the same thing, the same headings here. So can you again relay to me the figures from your printed copy?
Okay. Revenue.
Yes, revenue.
Revenue 12,000.
12,000.
And then 5,700.
5,700. Correct.
Cost of sales.
Cost of sales.
7,000.
7,000.
And 2,470.
70. And then
gross profit.
Yes. Well, it's fine. And then
operating expenses.
Operating expenses. Operating expenses.
3025.
3 what? 33?
025.
25, yes.
And 570.
And 570.
Profit before tax.
Okay, well, that one I'm just putting a formula. Then income tax expense.
Yes, it's 500.
Also, this is profit before tax. Then tax, income tax expense is 500.
And 760.
760.
760. Yeah.
Right. So
Then profit for year.
profit for the year. Profit for the year becomes, let me put the formula, equals profit before tax minus tax. Okay, so let me just drag the other figures. Profit before tax. All right. Okay. So there you go. So this is profit for the year. Now, all items in the statement of profit or loss are translated using average rate. So all you have to do is to come here and pick the average rate, 3,8. So you translate SAR with 3,8. So you say 3,8. And then it's a matter of copying that. And then through SAR 3,8 like this. And then you translate everything using 3,8 equals this over this. So everything translated at 3,8. I'm getting 500. So consolidated, notice how easy it is. Consolidated, you then say equals. So these ones which are, these ones which are translated, we can shade in yellow. We are now left with $. So you can now say equals this plus this. So you can see there. You can now drag, right? Actually, you can drag up to this. So it's now 1975. After you've done this, you then just say other comprehensive income, other comprehensive income, other comprehensive income. Now, other comprehensive income is now exchange difference on translation of foreign operation. Now, these are gains. You now say exchange gain on translation of foreign operation. Exchange gain on translation of foreign operation. Now, when you are preparing exchange gain on translation of foreign operation, you can now say working for. This one is a very, very short working because all figures we have. Then you say working for let me skip, say another, let me skip and put working for here. Then I say exchange gain on translation of foreign operation. This is the last working that you have to make. Because this one goes to other comprehensive income, no wonder why we did not calculate it for statement of financial position. So you say opening net assets at opening rate. Now you opening net, you may say opening net assets at opening rate. Notice, if you are given statement of financial position like this, sir, you are given closing net assets 6.2. Remember, net assets means share capital and reserves, 6.2, but we need opening. So if you are given closing and you are told that there was profit in units of 1,900, if you take out 1,900 from closing, you get opening, because net assets, they increase by profit. You get that? So opening net assets at opening rate, it's a matter of saying 6,200, which you are given. Then you say less profit for the year to bring it back to opening profit for the year of 1,900. So opening net assets, they become 4,300. At opening rate was how much? Was what? Meaning the rate for 20x6 is the opening rate. It was 4,3. So you say over 4,3. So opening net assets at opening rate, this is now dollars, equals 4,300 divided by 4,3. So it's 1,000. Then you say, what causes net assets to increase is, then you say add profit for the year is translated. Profit for the year is translated at average rate. So profit for the year, we have just done it above there. It was 1,900 translated at 3,8, and we got the figure as 500. All right. So in the absence of any exchange difference, we needed your net assets to be at this figure. But let us now calculate their closing balance. The closing balance of net assets is now closing net assets at closing rate. Closing net assets at closing rate, it's now 6,200. Your closing net assets is 6,200. Closing rate is 4. So you're now saying equals 6,200 over 4. So closing net assets is 1,550. So after making profit, we were expecting your net assets to be at 1,500. What then took them up to 1,550 is the exchange gain. It's a balancing figure, which is 50. So it is that gain. So you now say total exchange gains. There are now two total exchange gains. It's like on Goodwill, plus on net assets. Or you then get total exchange gain equals, you say this 50 plus the gain on Goodwill plus the gain on Goodwill, which is 59. So it's 109. So these are the total exchange gains. So you add 109 here, equals 109, like that. And then, 109,30 equals this. I put it in a wrong column, in a wrong cell. 109,38, and then you get total comprehensive income for the year. Total comprehensive income for the year. Total comprehensive income for the year. You are now adding 19. You are now saying equals 19, this one plus this. That's total comprehensive income for the year, 2084. And you know, NCI, in this case, NCI is a share of exchange gain on translation of foreign operation, but not on Goodwill, since the group uses partial Goodwill method. The group uses partial Goodwill method. There you go. So you can see here, we are done with the topic. Next week's lecture will be on something else like financial instruments or what. So we are moving at a very good pace. And you can't tell me that by merely playing this video once, you already understood the concepts. You need to replay it over and over and over until it sinks. So because I have taken much of your time, enjoy the rest of your evening, guys, the rest of your night. You have a wonderful week ahead. Come next month, we'll be giving each other assignments. Come April, meaning from next week going forward, we'll be giving each other assignments on CBE practice platform. So it will be a fantastic platform for you to practice. Cheers, guys. My pleasure.
Thank you, sir.
Sir.
You're welcome.